Canada's economy unexpectedly shrank by 0.1% in the first quarter of the year. Since that marks the second straight quarter of economic contraction, it triggers a very specific label, a technical recession. That label is immediate political ammunition. Opposition leaders are already pointing to this back-to-back drop as proof of top-level economic mismanagement. But the underlying data doesn't follow the typical recession script. While total GDP fell, household consumer spending actually grew by 1.5%. Corporate profits also surged by 10% compared to the prior quarter. Companies and consumers were both making and spending more money, contradicting the usual behavior of a shrinking economy. This chart shows how both can happen at once. The overall economic pie shrank slightly, but with flat population growth, the individual slices, the GDP per person, actually got larger. This means average living standards remained stable. The recession isn't hitting the average Canadian's wallet. If consumer spending and corporate profits are both up, the drag on the national GDP is coming from a different source, a freeze on business investment. Corporations are currently sitting on capital, but refusing to spend it on growth or expansion. Industry leaders point to a specific bottleneck, the uncertainty surrounding the July 1st deadline to review the CUSMA trade agreement. Without knowing what the rules of the road will be, businesses are hitting the brakes on new spending. This caution is tied to the physical reality of the economy. Canada relies on billions of dollars in goods flowing steadily across the southern border to its largest trading partner. When companies can't predict tariff rules 2 years out, they hoard cash instead of building factories. This hesitation effectively stalls the large-scale investment needed to drive growth. That missing investment ripples through data. It weakens total exports and pulls aggregate GDP negative, while individual households continue spending. Until the trade rules with the United States are stabilized and the threat of new tariffs is removed, domestic business capital will likely remain paralyzed. Securing a long-term CUSMA renewal is the immediate fix required to give businesses the confidence to start spending their reserves again. However, relying solely on a U.S. deal keeps the Canadian economy vulnerable to recurring American political cycles and shifting trade policies. This vulnerability has led to the U.S. Plus strategy, maintaining the American relationship while actively branching out into massive markets across Europe and Asia. Diversifying trade lines acts as an insurance policy, protecting the economy from future disruptions at the southern border. The second pillar of this strategy involves removing internal trade barriers between Canada's own provinces. These invisible borders currently act as a drain on national growth. The IMF has noted that clearing these domestic hurdles would provide a significant boost to the economy, independent of international factors. Finally, the focus is shifting toward fast-tracking domestic energy engines, such as the new Graphite mine in Quebec and the liquefied natural gas deal in British Columbia. Expediting these megaprojects and dissolving provincial red tape creates a domestic economic cycle that functions even when global trade is volatile. Clearing these diplomatic and bureaucratic bottlenecks is the mechanism that finally unfreezes Canada's capital and moves the economy past the technical recession.